welcome back to the final part of a rather long Saturday. I have been given 3 more standards and I have about 1 to 1.5 hours. I think the order which has been indicated to you is 37, 33 and 12. However, I am changing that slightly, considering that the income tax standard is the most important. I would like to start off with that and try and devote as much time on that and then follow it up with IND-AS 33, which is the second important one, and then IND-AS 37, which is not really much of a difference compared to our AS 29. So that is the order which I intend to follow. And I will try and wrap up by maybe 6 or 6:05. So that will leave us about 90 minutes. That is the time I intend to cover. Now, as far as this standard on income tax is concerned, IND-AS, including the math part, now that is a standard which is, I would say, a very deceptive standard, and there can be many complications which can arise. We may not be able to grapple with all of those. The idea here is to just get an overview, because the basic approach itself is different from the existing standard under AS 22 which we are adopting. And then there are certain transition issues primarily involving MAT, which I also intend to cover. And then there are other fundamental issues like certain special situations like consolidation, business combinations, undistributed profits and so on. I will try to focus on that. So, keeping that in mind, I think the objective and scope is essentially it covers accounting for all types of taxes, whether it is domestic tax, foreign taxes and any withholding taxes on any undistributed profits of subsidiaries, associates, joint ventures, etc. All taxes which are dependent on revenue, like your sales tax or now GST, VAT, etc. are excluded. See, there are certain companies who are taxed on a special basis. For example, shipping companies, there is this concept of a tonnage tax, where the tax rate is dependent upon the shipping revenue. Now that also, in our view, is excluded because it is not a tax really on an income, but it is more tax on the revenue, and similarly penalties and fines are also excluded. Otherwise, essentially the idea is to basically try and identify the accounting for the deferred tax and the criteria for recognition of deferred tax, and the presentation and disclosure requirements are also significantly different and much more varied and detailed compared to what we currently have as far as our AS 22, which is existing, is concerned. What is an accounting profit and taxable profit? Everybody knows what is a tax expense and the current tax. I think there is nothing really specific about that, so that I'll just skip through that. I think what is more important now is you have to understand that what is the tax base on an asset or a liability. See, the existing approach which we had for deferred tax was essentially a P&L approach which was there. So I am not saying that there was no tax base and accounting base, but it was more in the nature of the way you used to calculate your deferred tax is you used to take the computation of your income and then analyze the differences between what were referred to as the permanent differences and what were referred to as the temporary differences. Whatever were the permanent differences, there was no impact. Whatever were your temporary differences, that means differences where there were either some item where you would be getting a deduction based on certain conditions in the future, or you would be eligible for certain benefits in the future. Only those items were considered for calculation of deferred tax. Whereas now there is a concept of a tax base and an accounting base. So we have what is known as taxable temporary differences, and we have non-temporary differences, as we will see later. You will have certain kinds what are deductible temporary differences or what are deductible, non-deductible temporary differences, the liabilities and assets. So that is the fundamental concept. See, the other way of looking at it at a very macro level is your ICDSs which are there. The ICDSs per se now define your tax base. Because that is how, for tax purposes, you are required to maintain the books of accounts. Though the preamble of the ICDS states that this is not a question of maintaining books of accounts, it effectively means that you have to maintain detailed memorandum records. So effectively it becomes your books of accounts, and that is what essentially remains your tax base. So that is how it is. So deferred taxes are the amount of income taxes recoverable in the future, an asset, which is a benefit which you will get in the future. In respect of deductible temporary differences, some deductions which you will be available, or carry forward of your unused tax losses or credits, unabsorbed depreciation and so on. And deferred tax liabilities is the amount of income taxes which will be payable in future. So how do you measure your current tax? Even now also, you measure it at the amount expected to be recovered or paid in the taxation authorities using the tax rates and the tax laws which are enacted or substantively enacted. This concept of substantively enacted are of your clear what that means. What do you mean by substantively enacted? This is a concept which is already existing even under existing AS 22. So can anybody explain what is substantively enacted? Anybody has an idea? No? What is substantively enacted? I'm surprised that you all are not aware. Yes? No, going to happen means in what way going to happen? So can you explain with the help of an example?
Like the budget is...
Yes, exactly. So it is something which is already passed by Parliament and it is expected to be enacted when it's only a formality. So you may take your deferred taxes at that particular rate. So that is what is known as a substantively enacted rate. Deferred tax are measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled. Ultimately, deferred taxes ultimately deals with the future. So it is better that, and it is logical that we apply the substantively enacted tax rates if we know about it. And then there is no discounting which is permissible as far as deferred tax is concerned, though it actually is something which pertains to the future. Current tax, your recognition should be recognized as a liability. Everybody knows excess payments or advance taxes should be recognized as an asset. Benefit related to a tax loss that can be carried back or to recover the current tax for the previous period should be recognized as an asset. So normally now instead of the P&L approach, we follow the balance sheet approach or the liability method approach. So we have to recognize deferred tax on all temporary differences. Now what are temporary differences? Differences between the carrying amount of an asset or liability in the balance sheet. So it is the difference between your accounting base and the difference between your tax base. So that means you can have taxable temporary differences or you can have deductible temporary differences, each of which may result into either an asset or a liability. So that is how it is there. So it is, you have to have a concept now of an accounting base and you have to have a concept of a tax base. Fair value is an accounting base. Just a simple example. The fair valuation of financial instruments which you do. Whereas for accounting, is an accounting base, for tax base fair value is to be ignored. So that is a simple example of a difference between an accounting base and a tax base. So that may result into taxable temporary differences or it may result into deductible temporary differences. So that is the basic fundamental which you need to understand. There are of course other things also which are there which we will see. So now here these are 5 broad steps which you need to remember. See, if you read the standard, it gives a lot of paragraphs and narrative and all that. I have just tried to summarize it in simple bullets as to how you have to actually go about calculating your deferred tax for accounting and recognition. So first you have to calculate or know what is your tax base. Then you already know what is your accounting base. So then you identify what are the temporary differences. Now the temporary differences may give rise to a deferred tax asset or a liability. So then once you have identified which are the temporary differences that give rise to deferred tax assets or liabilities, you calculate that at the appropriate substantively enacted tax rate. Then recognize the deferred tax in income, equity, or as an adjustment to goodwill. Equity means, what I mean is under other comprehensive income, because certain fair value changes or certain revaluation adjustments or changes go through OCI. So the deferred tax impact of that also goes through OCI. Or certain adjustments which you may do during the course of a business combination may have to be adjusted against the goodwill. There are specific requirements which are laid down in the standard, which we will try to touch upon. But this is just the broad steps which we need to take for accounting and recognition. So what I have tried to do over the next few slides later on is explain it with the help of simple arithmetic examples rather than going into narrative details, which will help you to understand. So now we have what is the tax base. So you have a tax base of an asset, you may have a tax base of a liability, a tax base where there is no recognized carrying amount, or there may be certain situations where a tax base is not immediately apparent. We will look at each of these with the help of a series of examples rather than going into narrative explanations, just to get a feel of how to work out. What is the tax base of an asset? A tax base of an asset means it is something which will be deductible for tax purposes and against which taxable economic benefits will flow to an entity when it recovers the carrying amount of the asset. Can anybody give an example of an amount which will be deductible for tax purposes against which taxable economic benefits will flow to the entity? Any example? Can anybody think of an example? Huh? Yes, bad debts could be an example of provision which is there, which may be disallowed now, but it may be allowed in future when you actually write it off. Yes. So that is a simple example. Now, if these economic benefits will not be taxable, then the tax base and the carrying base amount, the accounting, when I say will be equal to its carrying amount, means its accounting base. So if there is no tax implications, then your tax base and accounting base or carrying amount is equal. So there is no question of identifying any difference and getting into any deferred tax asset or liability and so on. Okay, so that is the tax base. So examples of amounts deductible for tax purposes. We may have depreciation, which is the most common. We may have indexation benefits, or your capital assets, capital gains, shares, land. All that your tax base and accounting base will be different. It may be for a full amount or it may be for a partial amount. Some of the benefits may be over on one single year date later on, or it may be something which may be over a period of 5 years, 35D for example. That is something which you will be getting benefits over a period. So amounts deductible for tax purposes. Examples of taxable economic benefits are income earned from an asset's use and proceeds arising from disposal that enter into the determination of the taxable profits, your gains from capital gains which you work out. So what is the tax base of an asset? It is your carrying value in the books minus your future taxable amounts and plus your future deductible amounts. So the minus deferred tax liability or your deferred tax asset in simple terms. So you have a carrying value, you have some future taxable amounts, you have some future deductible amounts. So that is how you arrive at the tax base, the difference between the tax base and liability. So let us look at it with examples. So there is here a simple case, normally depreciation. You have a machine. For tax purposes, there is a depreciation which is there. Revenue generated from the machine is then normally taxable. And for accounting purposes, you have the depreciation as 20. So you have the carrying value, future taxable amount, because whatever revenue out of this asset will be taxable, plus the future deductible amounts is 70. What is 70? 70 is the difference which is there, your carrying value. 100 minus 30. So that is essentially your tax base. Okay. Now similarly, you have an inventory at the balance sheet date which has a carrying value of 100. The inventory will be deductible for tax purposes when we are sold. So your carrying value and tax base is the same. Inventory does not have any tax impact, whereas your depreciation, fixed asset, the carrying value and the tax value is different. Tax book value and accounting book value in a way. Now here you have another very common situation. You have a land which was acquired at 100. It was revalued to 150. The cost of the land at the balance sheet date for tax purposes is 110 due to its indexation benefit. So the tax base and the carrying base is different. Correct? Tax base is the index value of the land. Correct? Now here, so here this is the first case is where you have a recoverability of an asset. One scenario which gives rise to both taxable amounts and deductible amounts. Whereas now here the second scenario is you have a recovery of asset which gives rise to a taxable amount, but there is no deduction. It is not deductible at all. Let us see some examples. There is an interest receivable. The related interest will be taxed on cash basis. If it is an NPA, for example, then your tax base becomes 0, whereas your accounting base is 100. So taxation is on a cash basis, so currently there is nothing. Then you have a foreign exchange debtor having a value of 115 after recognizing an exchange gain of 15. So which means the original amount is 110, right? So the carrying value of the asset in the books is 115, whereas for tax purposes, this exchange gain is neutral. So that is 110 is the tax base. The original amount was included in the taxable profit. Then you have an R&D expenditure, which is claimed as a deduction when paid for accounting purposes. The research expenditure is a deferred revenue expenditure or an intangible asset. It may meet the criteria of a development expenditure under the intangible asset standard. So that is, it is amortized over 5 years. So as of date, the tax base is 0, whereas your accounting base is 100. Okay, clear? Some examples how you have your recovery of an asset which gives rise to taxable amounts but no deductible amounts. Recovery, you have an interest paid which is capitalized. So borrowing costs capitalized. Tax deductions are available under the fact when the tax deductions were obtained when the interest was paid. Your 3613 or whatever you may have. So you have the carrying value, tax base is 0 because it will not, there is no deduction available now. Now recovery of an asset does not give rise to any taxable amounts, but it gives rise to deductible amounts. Here we saw gives rise, here does not give rise. So let us see some examples. There are trade debtors here you have which has a carrying amount of 95. After after recognizing a general bad debt provision of 5, your ECL example, the original amount of 100 is already included in the taxable profits. Provision for bad debts we all know is not tax deductible, but would be so when the provision becomes specific or when there is a write-off. So you have a tax base of 100 and the carrying value in the books, carrying value is 95. Recovery of asset does not give rise to either taxable or deductible amounts. So here you have trade debtors having a carrying value of 95 after recognizing a specific bad debt provision. It is specific. The original amount is already included for tax purposes. So here your tax base is 95 because that is allowed. It is a specific write-off which can be allowed. Now what is the, so are we clear broadly as to how you determine the tax base of an asset? The difference between carrying amount and all that. So that is where you need to do an analysis for each of that. It is ultimately it is an arithmetic exercise. You know what is the value in your tax and what is the value for your accounting purposes. In a lot of cases now the IND-AS also will give you guidance. There will be specific situations. So those are what need to be identified. So that is the first basic step which you need to do. Now you have the tax base of the liability. It is the carrying amount of the liability as per books, less any amount that will be deductible for tax purposes in respect of the liability in the future periods. So in case of a revenue that is received in advance, you may receive some revenue in advance. The tax base of the resulting liability is its carrying amount less any amount of revenue that will not be taxable in the future periods against any advance receipts which are there. So here you have your carrying value minus your future deductible plus future taxable. This is the reverse scenario based on whatever we have seen. The simple case, you have a loan which is a carrying value. The loan repayment does not have any tax consequences. You forget your fair value and amortized cost. Simple if it is there. Tax base and accounting base is same, so no difference. Now you have a foreign currency loan with a carrying value after recognizing an exchange gain. So for the accounts it is 95 but your tax base is 100 because you ignore the carrying value. You ignore the exchange difference. Exchange loss will not be allowed. So to that extent the tax base remains 100.
When you say carrying value, it would be the fair value of liability in the books, right?
Whatever is the value in the books, yes. Whatever may be the value. Carrying value means the value in the books, whatever you can, yes. It would be the fair value or amortized cost and whatever may be the value, yes. So that is why there will be a difference. Here you have another scenario, a normal liability for wages payable, there is no deferred tax. Your tax base and carrying value is the same. Okay, nothing. Similarly, here you have a long service leave has been accrued at the balance sheet date in terms of your accounting standard. No deduction is available for tax purposes. It is disallowed. Okay, the leave provision which you make. So tax base is 0, right? Not allowed. Tax base of revenue received in advance is equal to your carrying amount minus of revenue that will not be taxable in the future periods amounts. Let us take an example. There is an interest received in advance at the balance sheet date. The interest revenue was taxed by reference to the amount credited in the income statement. So whatever is the amount credited in the income statement as for tax and books is the same. Now here you have another situation where you have a government grant of 100 rupees that is recognized as a deferred income as we saw rather than being deducted against the cost of the asset. Now you have the earlier both options were permissible. Now government grant has to be a deferred income. No tax is payable on the receipt or on subsequent amortization. No tax. So the cost of the asset is fully deductible It is in respect of maybe an asset where you are fully deductible. So your carrying amount is revenue is 100, tax base of it is 0. Because no tax is payable on receipt or subsequent amortization. This is only your book adjustment, tax neutral. Tax base of revenue received in advance. Here you have some royalties from users of a licensed technology related to the following financial year, amounting to rupees 100. The royalties are taxed on a cash receipt basis. The royalty income is deferred in the accounts until the period to which it relates. So there is no tax impact currently, whereas your carrying value is 100. Now your tax base with no recognized carrying amounts. What could that be? Your share issue expenses. You have your amount expensed in the accounts, but carried forward in the balance sheet. See, share issue expenses you may expensed in the accounts in the year of IPO, but for tax purposes under 35B or under whatever provision, this may be allowed equally over 5 years. So carrying base is 0, whereas your tax base is 80 in the first year, because it will be equally over a period of 5 years. So there is no recognized carrying amount. It is all charged off already.
This transaction cost on IPO.
Yes.
Yeah, adjusted against equity, right? So why are we saying as expense of an?
No, expense means it is basically.
As per accounting IND-AS, transaction cost on an equity issue gets adjusted against equity.
No. So even if.
So why are we
Sorry.
saying expense?
Transaction costs you say.
So when we say IPO expense.
No. All IPO expenses may not be. All of them may not be directly attributable acquisition costs.
Yeah, let's say those which are directly attributable.
This is over and above those which are directly attributable.
Okay,
see, there may be certain statutory costs which you have to incur. Those also are connected with share issue expenses. See, some advertising which you have to mandatorily give. That is basically a cost related to the IPO statutory cost, but it may not necessarily fall within the purview of a transaction cost. The transaction costs which you have to incur are only your stamp duty and registration charges. Those are only the costs directly attributable to the issue of the equity shares. Whereas there may be a whole lot of other fees which you may pay to the lawyers, merchant bankers, you may incur some statutory advertising and marketing costs and all those, which are also connected with the share issue, which may not necessarily fall within the definition of a transaction cost under IND-AS 109. There could be some such costs also which may be there, which you may have to charge it off. Because those are costs which you will incur. Tomorrow you don't know whether the IPO will be successful or not. But you still have to incur those costs. The IPO may fail, but those are costs which have already gone, which you have to incur. Road shows and the marketing and all that.
Yes, the IPO which is abandoned or which fails.
Sorry?
IPO which is abandoned or fails.
Yes.
Then those expenses are expensed out.
Those are expensed out, abandoned, or even if it is not abandoned. See, all of it may not necessarily, they may be connected with the IPO, but they may not fall within the definition of a transaction cost. If you read the definition of transaction cost, those are the costs which are the unavoidable costs, which are your stamp duty or registration fees, or only those type of expenses that be taken within the purview of a transaction cost. See, of course, another complication can arise, whereas in some of the cases, all the share issue expenses which you incur may be even debited to the securities premium account. So, there in that particular case, you may not. But this is only if there are any expenses. See, this is a hypothetical scenario where some of the expenses which are there, but the ITO may not allow everything. He may allow only over a period of 5 years. There could be various, and essentially something which falls within the domain of 35B. See, I am not too much of a tax person, but there could be scenarios with certain expenses you can only claim over a period of 5 years under section 35B, but which in accounts you may write it off. Because now under existing AS 26 also, and maybe even now under IND-AS, you cannot show anything as a deferred revenue expenditure. See, this analogy can also be applied to certain other items of costs also, which may be charged off for accounts, but which the tax authorities may not allow you to charge it off entirely in the year of incurrence. The principle is essentially for those. Yes, Jayesh.
No, so just to add,
Yes.
there will be certain IBO expenditure which you will be adjusting from a security premium.
Yes.
So if it is allowed as per the, it is allowed and it is allowed and it is adjusted. And if you are getting tax break on the basis of 35D,
Yes.
you have to net off that.
Yes.
And then only you can take a using credit.
Yes.
So then you will net off.
Net of the tax, yes.
And you will create deferred tax liability.
Yes.
Whenever deferred tax asset.
Yes.
Whenever you will get this deduction, deferred tax asset will get adjusted.
And the other, just to add, the point which I was coming to, in fact, when we will come to it later, is that items which are adjusted against equity or against OCI have to be also, the deferred tax impact of that also has to be taken to the OCI.
So it should be net of the deferred tax.
Yes, net of the deferred tax. Yes, so which is what maybe later on I would have covered it. But this is just to explain for the time being. Yes. Now, tax base not immediately apparent. See, now here there are certain cases where there may be an entity which should recognize a deferred tax asset or a liability, but it may not be very clear. Those may be very rare situations, probably, where a tax base may not be immediately apparent or the tax position may not be very clear. So there I think you still follow the same fundamental principle which we have adopted earlier. So this is just to summarize. If the carrying amount is greater than the tax base, then for assets you may have a taxable temporary difference, or you may have a deferred tax liability. And for liabilities you may have a deductible temporary difference which results into a deferred tax asset. And if the carrying amount is less than the tax base, you may have a deductible temporary difference for assets which will result into a DTA, or you may have for liability a taxable temporary difference which will result into a DTA. It's just ultimately arithmetics. So this is how you would have to summarize. Even now when we were taking your permanent and temporary differences, it was basically on the same lines. Are we clear? See, it is ultimately logic, nothing else. See, now when do you recognize a deferred tax liability? Should be recognized for all taxable temporary differences. Liability means it is for all taxable temporary differences, whereas an asset means it is for all deductible temporary differences. Right? Unless the deferred tax liability arises from initial recognition of goodwill, that you cannot. That is a specific carve out, or something from the initial recognition of an asset or liability in a transaction which is not a business combination and which affects neither accounting nor taxable profit. So which is tax neutral. So there is no question of any deferred tax liability, which is not a business combination. A business combination you may have to account. There may be special recognition exceptions for investments in subsidiaries, joint ventures and associates, which we will briefly touch upon later. Otherwise, the principle is simple: all taxable temporary differences, unless it pertains to initial recognition of a goodwill, or it is an initial recognition of an asset or a liability which is not a business combination and which does not affect your profits, taxable and accounting profit. Now for consolidated financial statements, what do you do? Currently, how are we working out the deferred tax at the consolidation level? We are just doing an arithmetical aggregation. We don't really do any separate assessment at the consolidation level. Now that is a concept which will change, because even at the consolidated level, so you have to compare the carrying amount of the assets or liabilities in the consolidated financial statements also with the appropriate tax base. The only care which you need to take is that here in India, the income tax returns are still filed for the individual companies. Whereas globally, there is a concept of a consolidated tax return which is filed at the group level. So you need to say, now you may have companies within the group which are Indian subsidiaries or joint ventures and which may be international. So some of the international subsidiaries and all as a group, some of them may be filing in one jurisdiction. So when you determine your tax base, you will have to take it with reference to the tax return in the jurisdictions in which the return is filed. So in some cases it may be individually, in some cases it may be at the group level. So that is, it has to be with reference to the appropriate tax returns when you need to determine your tax base.
Excuse me.
Yes.
Just for simplification purpose, let's
Yes.
say I have all subsidiaries in India.
Then there is then you just aggregate the tax base based on individual returns.
Individual.
Yes, yeah, you compare the tax base based on that and then you have your accounting base. Yes.
I think the question will arise only when it's a group which is consolidating worldwide.
Worldwide, yes.
That's where this is all going to come up, because you have consolidated tax returns where you also consolidate not only the federal, that is the central, but also the state tax returns are consolidated in certain jurisdictions in Europe, certain jurisdictions in North America. That's where you have to do this exercise of going back to the base, the tax base, and making a reference to that. Actually, whenever I normally speak about the tax one, I always tell people is that you have been used to looking at your computation of total income and trying to find out your deferred tax asset and liability on an income statement basis, whereas this has changed to the balance sheet level. Therefore, it makes a lot of sense. And all the slides which Zubbin used, he talked about a tax base, tax base, tax base. That means you really need to have all your assets and liabilities.
A tax balance sheet.
Yeah, the balance sheet. So the tax balance sheet approach, if you do, it will be simpler for you
Yes.
to analyze the deferred tax asset and liability. Otherwise, it's going to be a nightmare for all the functions of all the accounting and the financial groups which are available. You will not be able to come to he said arithmetical accuracy. The accuracy itself is a question. Just in the morning when he was talking about conversion of a asset to an investment property. Imagine the time when you use that asset as a business purposes, you were depreciating. An investment property in a different scenario, you change it from one to the other. What about the deferred tax asset and liability impact over the years that have taken place? What do you do to bring them on the balance sheet? So if you look at this, there is a lot of arithmetical work, of course, with the accounting aspect. Therefore, think logically, and if you start on a small basis preparing your tax balance sheet, you will be in a simpler position to prepare your deferred tax assets and liabilities, or else you are going to have a nightmare. Every year you want statement, previous year's financial statements, and start looking at the tax base.
And now your ICDS is itself give you the tax base for preparing your tax accounts.
But essentially, people have been used to doing deferred tax calculations in an Excel spreadsheet, which is not part of the ERP. Now that is a nightmare if you imagine that you are a group with a consolidation. Even if you have all India, you will still have a lot of work to do. So Excel-based sheets and all will have to really give away, and you have to get it into your system. Unless you're a small organization, which you can still manage with Excel spreadsheets, and whether you can manage to maintain the right file, which is the last one that I used, and where did I keep it? So that's very important.
So what you all suggest is drawing up a tax balance sheet and then comparing the numbers.
Yeah, it has to be. You have to have a tax base, means you have to have tax accounts. That is what I said. Though the ICDS may say that there is no need to maintain books or accounts, but effectively now you have to maintain the tax books or accounts also. Whatever you may say. Now, what is the goodwill? We will go to consolidation, some other aspects later on. Let us first see goodwill. Now, what is goodwill we all know, and you will also look at it when you will be looking at the business combination standard, which is nothing but the excess of the acquisition cost over the fair value of the asset. Now, goodwill is to be recognized as an asset. It is not permissible to be amortized, but it has to be tested for impairment. So when the cost of goodwill business purchase is non-deductible for the tax purposes, your tax base of goodwill is nil. Without getting into the legalities and all that, here we are assuming that the goodwill is non-deductible for tax purposes, without getting into the details of the law. So here the difference between the carrying and the tax base is nil, which will give rise to a taxable temporary difference. So that itself will straight away result into a deferred tax liability. However, IND-AS does not permit recognition of goodwill, as this is measured as a residual between difference of the cost of acquisition and the fair value, and any non-recognition of DTA will only increase. So we saw the exception earlier. On goodwill, there is no question of any deferred tax liability which comes into the picture. That is the reason. Deferred tax assets are recognized only to the extent it is probable. Now the other main difference is the concept of virtual certainty, which was there for recognition of deferred tax on carry forward losses and unabsorbed depreciation, is no longer there. You have to now, as long as it is probable that there will be future taxable profits, you can recognize. So the criteria for recognition of deferred tax asset is a little less stringent, if I may say so. Though probable is not defined, there is guidance indirectly contained. Certain factors which need to be taken into account for recognition of DTA for unabsorbed losses. See, there has to be first sufficient taxable temporary differences. So there has to be first deferred tax liability which has to be there. There has to be convincing evidence that sufficient taxable profits will be available in the future and losses are unlikely to recur. That means if your business is turning around, you can consider recognition of a deferred tax asset. You need not wait for virtual certainty supported by convincing evidence, disclosure of what is the evidence, and then the institute guidance also, which was there for AS22. Then what is the nature of evidence, only binding purchase orders, sales orders, and so on. All that is not required. What are also the tax planning opportunities which are available? So based on all that assessment, you may be able to, you should be able to demonstrate. This is one important area of judgment. I talked under IND-AS 1, major management judgments and estimates. So this is one area, especially where you have unabsorbed losses or depreciation. At the end of each report,
including unabsorbed losses and unabsorbed depreciation.
Yeah, both. This is mainly, of course, for losses. Unabsorbed depreciation is much more simpler. You will know from your tax base and the accounting base of assets how much depreciation you will be having and whether you will be able to recoup that. That is much easier. It is mainly for losses, unabsorbed losses. So entity may recognize and should recognize unrecognized DTA if it is probable that future taxable profit. So here on transition also, this is an important consideration. Now in a business combination, what happens? Their assets and liabilities are recognized at the fair values. However, the tax basis of the individual assets and liabilities may not be affected. The tax base will be different from the accounting base, which is now at fair value under business combination. So changing the carrying amount affects the temporary differences and accordingly results into deferred tax. So that is why when you saw initial recognition is permitted, not permitted unless it is in a business combination. So there you can recognize even on initial recognition in a business combination. So you have acquired certain entity and the assets and liabilities are taken at the basis of the fair value under the acquisition method. You can recognize the deferred tax, because the tax basis of the individual assets and liabilities will remain the same whatever was there. Whereas here you are doing a fair valuation when you are doing the acquisition accounting under IND-AS 103 of business combinations. Except that any deferred tax liability on goodwill which we saw earlier, we don't recognize. Now recognize the DTA.
Business combinations on cost basis, the question is
under common control it may not arise. But this is under the acquisition, the normal acquisition method where you do the fair value, yes. The DTAs of the acquiry, once you are satisfied with the probability criteria for the acquiries, things you will have to see whether the DTA or that probability criteria is met. So you need to make an assessment of what is the acquiree's tax status and all that based on the return. And if you can need to make an assessment at a later date, and if new facts and circumstances come into the fact, then you can adjust the goodwill and reassess goodwill for impairment. If goodwill is in, recognize the deferred; if not, recognize in P&L. So if there is no goodwill, then you may recognize it in the P&L. So there is no time limit. You can make an assessment at a later date also.
I didn't understand. So is this a
No, I see on the date of acquisition, you may know from whichever the entities which you have acquired. So at the first year, you may not be able, you may feel that they have some unabsorbed losses, or maybe having some other differences which may be there, but it may not be probable. The probability criteria may not be met for that individual entity, or maybe at the consolidated level. But later on, the situation may change. So you may reassess later on, and then after 2 years, you may find that for these part of those entities, assets which you have acquired, now you are able to recognize deferred tax assets. So you can recognize the deferred tax assets and adjust it against the goodwill. But if there is no goodwill itself recognized, then it will have to be recognized to the P&L. Otherwise, you adjust it and reduce it from the goodwill which is there, the deferred tax asset mainly. Now, investments in group companies. Now, when a parent or an investor acquires such an investment, it is accounted in its separate financial statements. You can recognize it at cost. That is an option which is permissible. In the consolidated financial statements, the investment is recorded on a line-by-line basis when it gets nullified, or under the equity method in case of associates and joint ventures. So because of that, a temporary difference may arise between the investment's carrying value in the separate and consolidated financial statements and its tax base. Now the carrying amounts may be recovered. How do you recover these carrying amounts? These carrying amounts, either you may dispose of the investment, or you may distribute your undistributed profits as dividend. So you should recognize the DPL for this unrecognized profit, undistributed profit. Unless you are able to demonstrate, you as the investor are able to demonstrate that you are able to control the timing of reversal, and that you will not be taking any dividend from your group company, then in that particular case you do not recognize any deferred tax liability. Otherwise, you need to recognize the deferred tax liability, and that would generally be based on your DTL position and the dividend distribution tax which is there, because that is what is the tax consequence. So on that you will have to recognize your deferred tax liability to the extent of the dividend distribution tax which would have to be paid when the dividend is paid by the subsidiary company to you. And of course, subject to other conditions. If it is an international subsidiary, then there will not be any DTT set off of the dividend distribution tax, and all those factors have to be considered. But the tax consequences all have to be looked at, and naturally there will be a deferred tax liability. So that is again one important assessment which you need to do.
But I have a DT in the next year. What do I do for a
What? Sorry?
I have a division which is declared in the next year.
No, it may be declared in the next year, but it is likely to be declared, so it will impact your carrying value in the future. So you recognize the impact as of now. You recognize the impact as of now. You have your undistributed profit.
Yeah, so undistributed profit.
So to the extent of the undistributed profit, the DTA, you assume that will be distributed as dividend, and on that assumption. It is an assumption. This is a major change. Unless
what you are doing is we are assuming that the entire undistributed profit will be distributed by
unless the subsidiary company, unless the holding company resolves that no, I am not going to call for dividend in the foreseeable future. I will not take dividend from my subsidiary. Then you need not. And which is what many companies do.
How is that to be evidenced by the holding company?
No, that holding company has to give a representation. There is no other evidence. See, there may be a past history that it has never taken any dividend from that particular subsidiary. So then that could be an evidence. That could be. So that is again management judgment and estimate again. It is a management judgment call. There is no other way in which you can. They may say for 2 years, then third year you may change his stand. So then in that particular case you have to recognize it.
It's very dynamic and you cannot have an answer.
Yes.
You know,
How can you have this clause where you have a listed companies not taking dividends from
You can resolve if it is your 100% subsidiary.
Not
you
a
can
share
decide.
saying it's a listed company.
When I'm saying it's a listed company, how do you exercise this option? If
You
it's a-
can, I mean, as I said, it is something which is very judgmental. It is difficult.
Listed company.
Listed company, I agree, it may be a little more difficult, but you can never say.
No, so there are 2 things here in my view to consider. One is the subsidiary.
Yes,
Subsidiary, as per definition, you need to have a control over it.
yes.
And if you have a control, you definitely have a control over a distribution
Not
of
dividend, you can exercise
right?
control.
Because what you require for a dividend distribution is more than 50%.
Yes.
And if there is a resolution for a dividend, you have more than 50%.
You can.
Should we exercise that control?
Yes.
Jayesh bhai, in the current scenario, even if that 50% is not there, the control factors will help to generate that thought process.
Yeah, so that is one thing. Second thing which is very important is that when dividend is distributed by your subsidiaries, you get a rebate
Yes.
for your distribution tax. The question here is that distribution tax which you pay on your dividend will as such go as a part of an adjustment to retained earnings.
Yes.
It is not coming into your PM. These subsidiaries, whatever rebate you will get, whether you can adjust that or not, and if some amount still remains, whether that should come as a part of the tax item or it should come as it can be a retained earnings also.
Yes.
I think that is,
Yes.
to my mind, not yet.
Not
also-
very clear. The DTT, whether the dividend distribution tax, whether it should be treated on par or it is an independent expense is not very clear.
So my, with your permission, I will say my view. My view is that it is like a tax which you are paying on your income.
Yes.
And as a holding company, you are a shareholder of a subsidiary company, so you are paying tax on that, and that is why in holding company it should come as a charge,
Yes.
and not
I am sure.
adjustment to the return.
Yes.
That is one. Second thing is that if you are able to adjust with your dividend distribution, because for a subsidiary it is allowed, then in that case, still you take a charge and on gross basis you take a return earning. That's a question I
Yes.
think which needs to be examined. Most of the people are adjusting with the return earning.
They are adjusting.
They are adjusting in return. The question will be on associates and
Joint venture.
where you will not be able to say that you have control over it. And if they are declaring dividend, then in that case, for force to my mind, you need to take this charge. And this charge, in my view, has to be taken, if at all, in P&L.
Yes.
Then it has to be taken as a part of a tax item.
Yes.
And not as a part of rates and taxes.
Yes.
Because I have seen people taking that as a rates and taxes also. It is nothing but a payment for the dividend distribution. It means payment against the income which you have generated. And that is why, to my mind, it has to be tax item. But some of the clarification I think we should evolve.
Yes.
I think what you are coming from is from the past phase 1 companies where this has been done.
Yes.
As phase 1 companies, there has been a varied practice, and that's where it's coming from. So it's, people have done it as part of rates and taxes, but actually, it's very simple. That is part of your income. It's a dividend distribution
It
tax.
should be
It's
as
not
part of a normal
So it should
income
be
tax.
part of the tax expense bracket.
So the consequent future tax consequences of all this is what you need to factor in when you work out your DTN.
So the related thing which comes is that when you are implementing for the first time, what you will do with the undistributed profit up till now.
That is what the transition and all that we need to. So that I've covered in the transition challenges. Yes. So this is by far one of the most important criteria, I think, which Jayesh has, I think, brought it out maybe more clearly. I think so. Revaluation of assets again, because of revaluation, the tax base becomes different because tax people do not permit a fair valuation. So there the tax base and the accounting base will be different. And here your resulting DTL or DTA will be directly recognized in equity, since any change will also be recognized through the revaluation reserve. Tax consequences. Now this is where I think undistributed profits, tax consequences of dividend, the tax on undistributed income is different from the tax on distributed income, which is what I think is what we have already just discussed. Now there are certain situations where the deferred tax, current tax and deferred tax is recognized outside the P&L. If the item is reflected through other comprehensive income, the tax effect of that also has to go in OCI or in equity. Like the example of transaction cost debited to securities premium or any fair value adjustments which you may do through your equity shares, which you may take through the OCI and all that, the tax base and accounting base. So that changes will directly go to the OCI or to the equity, depending upon how the base transaction actually goes. Presentation, I think you can probably read through that. Offsetting also, currently the principles are there only if there is a legally enforceable right to set off and intends to settle on a net basis. Only if it is within the same taxable jurisdiction. That is a principle which is already there in our existing AS 22 also. Now in the consolidated financial statements, a current tax asset of one entity is offset against another entity if and only if the entities have a legally enforceable right to make or receive a single net payment, which in India is normally not permissible. That may be permissible probably for some of the entities abroad. In India, each entity is a separate taxable entity, so this is not permissible. Deferred tax also offsetting same principles, what we saw for current tax, and it is already there under AS 22. Disclosures, we'll just quickly run through classification, current, non-current and all that we all know. In the P&L statement, unless it is something which goes to other comprehensive income directly in equity or under a business combination, if it is there separately, it may be taken against goodwill. So which is what we have seen. Items could be recognized in other comprehensive income. This is just some of the examples which are there. So we have to disclose those separately, which are directly adjusted to equity also. Some examples of those: equity components of compound financial instruments or accounting policy adopted retrospectively which goes to retained earnings, so that tax effect also. Your general analysis of the tax expense, unrecognized tax consequences of dividend or business combinations, tax related contingencies, all of us have been disclosing all that. Post balance sheet changes, your substantively enacted tax rates. Then even IND-AS 1 makes a reference accounting policy to include measurement basis, accounting policy to include all the judgments, sources of estimation, uncertainty. So all this would be very much relevant for the income tax related disclosures also.
What would be the measurement basis for taxes?
Measurement basis is what we saw. I think at the rate, substantively enacted rate and all that, current rate, substantively enacted rate, all that is your measurement basis. That is the measurement basis. At what rate? So all the analysis and all that, this is the tax loss and all that which is there. Deferred tax also. Much more detailed disclosure, origination, changes in the tax rate, tax losses, any write-down, reversal of previous write-downs and so on, so all this you can go through. Any discontinued operations, if it is there, the tax consequences of that separately. Relationship between tax expense and accounting profit. So here is where you need to essentially, when you are preparing your financial statements, it is important that you have your tax computation in a reasonably final shape, because that is when then you can get into from your accounting profit to your tax. So whatever are your significant tax-free incomes, your disallowances, your tax losses, any other adjustments and all that, once you refer to that, you need to summarize. I have explained with the help of an example later on.
So the applicable to consolidation as well.
Consolidation also, and also for the standalone. And that you can do it, either you can do it on the basis of a rate, or you can do it on the basis of the actual amount. So tax expense and the product of the accounting profits multiplied by the applicable tax rate. So you have an accounting profit of 100, whatever is the tax rate is 34 point whatever percentage, and then based on that you work out. See here you have your accounting, just one example I have seen year 1 and year 2, you have your accounting profit under comprehensive income applicable tax rate of 35%. So 3510. And then you may look at your return on income. And in your return on income you have all these expenses which are disallowed or expenses which are allowed and all that. So once then that you arrive at your tax expense. Whatever is the provision for tax which you have made and your deferred tax and all that. So that is how you give your amount method, percentage method. Sorry, it's actually percentage method. I should have changed the heading. So you have your applicable tax rate and then you have your tax expense at this rate. So it is on a basis of common size statement. Now, wherever you have unused tax losses and unused tax credits, the amount of deferred tax assets and liabilities, and there that you need to identify separately because of unused tax losses and unused tax credits, many tax holiday benefits which you have, which you still have. So that also the impact of that, what is the expiry date, especially where you have not provided any deferred tax. Then aggregate amount of temporary differences associated with subsidiaries, investments and subsidiaries and joint ventures which have not been recognized, where you intend basically that you will not be calling for any dividend and which you have not recognized.
What is this expiry date you are referring to? How do you arrive at the expiry date?
So you know from your tax loss for 8 years or whatever is the period up to which you can carry forward your tax losses. So you may not recognize when will they expire maximum.
End of the holiday. Holiday period.
Tax consequences of undistributed profits that were proposed or declared after the balance sheet date. Corporate dividend tax in India which we declare afterwards. So that also the tax consequence. Undistributed profits also similarly. A lot of narrative disclosures are there.
I think one needs to understand the magnitude of
Yes,
disclosures
magnitude of the
and understand how to build it up on a regular basis.
Yes.
If you remember, there was a statement by Dolphy this morning that many
Companies
have
missed the deadlines.
defaulted. And it's absolutely possible because if you haven't seen something like this, the magnitude of disclosures, I mean, if you're used to international accounting with some of your corporates internationally based, you're very much used to this.
Yes.
But otherwise, imagine each slide here
Yes.
has some disclosure aspect which comes out actually from your statements only,
Yes.
but you have to have the wherewithal at the beginning of the month or at the beginning of the period
Yes.
that this will be utilized for disclosure. Otherwise, it's like stating that everything is in the mind. I know everything, but I don't know where it is. And at the end of the period, when you have to start disclosing and the auditor comes and asks you to give me all the disclosures, you start sitting down to prepare it, it's a nightmare.
You cannot do it.
Never. Therefore, the practical way of doing it is numerical exercise. The moment you are doing the numerical exercise of preparing your current tax, the deferred tax, the deferred tax asset and liability sheets, the same time the qualitative aspect of that, unless you knew that, you wouldn't have done the number crunching. So basically what it means is you just have to keep a well documented record of how you arose at each number, and that's going to be disclosed at the end, because this is your disclosure. It's not something new that is coming from elsewhere that you have to create it afterwards. It's just that you have to preserve your working in such a fashion that it is available for disclosure based on the requisition.
And if I may add here, see, most of the companies currently focus on the tax, but from a different angle as to how to minimize your tax liability, how to fight the various litigations with the tax department. So all the data and information is available. That same data and information has to be constructively now used even for the purposes of these disclosures.
The first phase companies would have come with good reports. Which are those companies?
Sorry?
Detailed reports.
No, any of the top tier listed companies, I think you can see. See, some of them have given, see, all of this may not be applicable to all of them, but a lot of the top tier companies, I think the top nifty 50 companies, if you see, most of them would have given these disclosures. Yeah, I mean, all of them may not have given all what should be, but they have given. So there is now you have the advantage of actually referring.
I can tell you that you'll have to you'll have to see a couple of them.
Yes.
Because they are industry specific.
Yes. So it is different.
I can make a reference that pharma companies had a real nightmare because of these questions. The IT companies
are much better.
A bit better because they had the data available in that sense. So I would say it's a mixed bag.
Yes.
But just to name a few, Dr. Reddy's will be one of them. Infosys
is good. Yes, I have
as I can say, I can look up whatever we also normally refer to and send out an email. But these you'll have to decipher industry wise because you cannot make it's a mixed bag.
Mixed bag.
And all of these things have different repercussions. Certain we started preparing as to the learnings from IND-AS 1. And we started to see what are the measures or what were the major reasons why, it was disclosed why the profit went down or why the element of the VAT was over so much. It was varying from industry specific. The automobile industry had a very different perspective. So yes, but you'll have to see. You'll find plethora of information, I believe, in Infosys from an IT perspective.
Yes.
But then you cannot compare the balance sheet to any of the other ones. So you have to.
You need to see many balances.
No, you have to look at many. I mean, you have to look at. I mean, it's difficult to name company A, B, C, X, Y, Z. So business combinations also specific. The contingencies disclosures, I think all of which I think we are quite familiar with giving all our contingent liability. So that is something which is not new. Now there is another issue, MAT, which is there. The transition issues and challenges. We all know that MAT 115 JD provides a framework for computation of book profit. Now, the first bullet here is the most misleading according to me. It starts with that no further adjustments to the net profit before other comprehensive income other than those already specified shall be made. No further adjustments. As if these adjustments are less. As if these adjustments are less. See, here you have to just understand one simple concept. One is that we have seen in the morning that there is something like an OCI. And in the OCI, there are a lot of adjustments which are there. What are the type of adjustments which come to the OCI? They are essentially fair value related changes or translation changes on foreign exchange gains and so on and so forth. So they are basically all unrealized profits or unrealized losses in simple terms. The other aspect which needs to be kept in mind for MAT is that when you do a first time transition, you adjust a lot of things to the retained earnings, which otherwise in the normal cost you would have taken to the P&L. So then there is a principles have been established for that. Those would be essentially changes due to the fair value as a deemed cost which you may take. So there MAT makes it very clear that anything which you do a fair valuation is MAT neutral. So you have to ignore that. The second principle which emerges is that anything which you take to the fair other comprehensive income, any fair value changes, you take it for the purposes of MAT in your book profit only on the actual realization. Third cases is that there may be certain other adjustments which may not fall within any of these. So those you equally take over a period of 5 years. The transition first time adjustments which you do to your retained earnings. You may book a decommissioning liability for the first time. In the normal costs, you would have taken it to the P&L. So now you may probably adjust it over a period of the next 5 years. So here again, there is one more layer of record keeping which is there, is where essentially your memorandum records for MAT is what you are required to maintain. So as I said, there are certain items in other comprehensive income which will be permanently recorded in reserves and will never be reclassified to the P&L account. So at what point of time should these be presented, we will see in the next slide. Changes in your revaluation surplus of property, plant and equipment and intangible assets. Revaluation changes. So there only when you dispose of any items which are revalued, they will be included in the book profits at the time of realization, disposal or retirement. Any gains or losses from investments in equity instruments designated as fair value through OCI to be included in the book profits at the time of realization, disposal or retirement. So simple logic, or realization. These are all unrealized gains or losses. So when you realize it, you take it, adjust it to the book profit. Remeasurement of defined benefit plans, actuarial gains and losses every year as the remeasurement gains or losses change. Any other item to be included in the book profits in the year in which the actual realization of the gains or losses occurs. So that is how you need to take it, whatever items are under OCI, or in the way you can say a crude form of receipt basis. A crude form of receipt basis when your profits will actually a realization basis. The first time adoption, the adjustments recorded in OCI and which would subsequently be reclassified to the profit and loss account to be included in the P&L in the year in which these are reclassified to the P&L. Adjustments recorded in OCI which would never be subsequently reclassified to the P&L shall be included in the book profits as specified in the next slide. Revaluation of PPE, same logic. Investments in equity instruments we already saw. This is one important change here. Defined benefit plans, actuarial gains and losses on transition which you adjust to OCI, you have to take it to the P&L for math purposes over a period of 5 years. And any other item to be included in book profits equally over a period of 5 years starting from the first time adoption. So here for the next 5 years, whatever transition adjustments you have done through the retained earnings, you will have to analyze those and see which can be taken on the basis of actual realization and which have to be taken over a period of 5 years. All other adjustments recorded in reserves and surplus excluding capital reserves and securities premium account and which would never subsequently be reclassified to P&L again have to be taken over 5 years. Where fair value is being considered as a need cost on transition, you have to ignore that fair value. So this is very important. You may have done fair value, but you have to ignore that. And the gains or losses also, so you have to ignore for math purposes as if you have done a fair valuation. And this amendment and clarification came in the last quarter. Companies, some of them had already done it for the first 3 quarters. Some of them may have reversed, many of them may not have, so now they are stuck up. Investment in group companies also similarly where you have taken the fair value as the need cost. Cumulative translation differences, foreign exchange on actual realization or disposal of the foreign operation, you take it. All other adjustments to retained earnings like your decommissioning liability, your borrowing costs, your decapitalization, all other adjustments which you do to be included in book profits over a period of 5 years from the date of transition. They all would have otherwise normally gone to the P&L, either gain or loss. So that has to be taken over 5 years. So you need to maintain memorandum records for the next 4 years at least after this.
5 years will start from 31st March 2017 for second phase companies.
Yes. Yes.
So it's 1st April 70. 1st April 70. From that perspective, there is something known as conversion date.
Transition date.
Transition amount and the conversion date.
Yes.
Conversion date is the first day of the reporting period. So
Yes.
second phase company
Yes,
is
it is
1st April
17. Yes, absolutely. Now transition issues, there are no
There is one issue here is that on AS 15, this actual cleanup loss which we are taking into OCI,
Yes.
people are saying that will never flow back to PL.
No, but currently the companies were charging them off to PNL in any case.
Yeah, but
That is a gap difference.
in future when you take it to OCI, there are two parts to OCI. One is that which will flow back to PNL, the items which will never flow back to PNL.
So here this is a specific carve-out. I think that the statute itself has laid down that you take it equally over a period of 5 years, whatever
Yeah,
the changes.
but if it is not going to flow back into PNL, then why it should be taken? So that was the issue.
Yeah, but I think
That is what people are
yes.
saying.
But I think ultimately here it is a specific requirement under the section because this is an adjustment I think which is permitted under IND-AS which was not there earlier.
Actually, just to clarify on this also, in your question when you were asking me of the various companies, see, one has to be very careful. The very mature companies have also done IFRS. Those which are on the listed outside, they have published everything. They published IFRS, they published IND-AS, they published the normal account. So what has happened is you can look and see. Otherwise, you get a little confused over those various cases as to how they are.
The problem in Infosys is they don't have liabilities, right? They only have an asset.
Because that's what I said, it will be industry specific, you could know. They have only cash on their balance sheet. And they are not leveraged, so what is the discount rate to take into account?
Yes.
They have no borrowings, so what is the discount rate for them?
That you may not know the discount rate which they have taken specifically. Achha, now the transition issues and challenges, there are no specific exemptions or exceptions to first time adoption. So you need to, as we said, establish a history of all your items. You need to go back in time. The common adjustments will come basically because of undistributed earnings, your deferred tax on losses which you were earlier taking on virtual certainty. You may now take it slightly leniently. Indexation adjustments or your land, investment property, impact of any double tax treaties. These are some of the main points which I could think of which are there. Now let us quickly.
Yes, yes.
So another important issue which comes in is that in consolidation, when you eliminate profit element because of inter-group transactions, I have not seen people adjusting tax.
Yes.
On that, to my mind, it should be part of a deferred tax.
There is some
adjustment.
idea for it carries
Yeah.
that I think.
Yeah, but it's not clear and many companies are not adjusting that. So when you are eliminating your profit, in my view, you need to also take tax into account when you are eliminating.
Now the next standard on IND-AS 33, I'll just very quickly go through the key features. See, basically the standard EPS is broadly the same because EPS means EPS. The definition is the same. The only challenges which arise are in case of certain structured instruments, the compound financial instruments which you may have, where I think how do you take the dilution, the conversion features into account. That is one area where there could be challenges, or where there could be certain other options or those sort of things which may have been given. So which is where how do you factor in the probability and all of conversion and how many shares will be issued, the potential shares to be issued. So these are essentially the areas where there are complications. So we'll just quickly, the objective and scope, ordinary shares, potential ordinary shares are your financial liabilities or equity option, because your preference shares now the situation may change. They may now become a debt, they may not become an equity shares. So there is no question of any EPS. Basic EPS, we all know what it is. See, the earnings attributable to equity shareholders, how do you determine that? You have your PAT. From that you minus the preference dividend and the dividend distribution tax, if any. So that we will just see in the next slide. You have to add your redemption, add or less your redemption premium or discount on buyback or redemption of preference shares. So this is one area of complication. Adjustment on premium for induced conversion of preference shares. An adjustment of debit or credit to securities premium account, which is required to be charged to the P&L account. This was already there even now also through a separate clarification, that where any item has been debited or credited to the securities premium, which is otherwise normally required to be charged to the P&L account under other IND-AS, that is what also you need to reduce it to arrive at the profit after tax attributable to premium or induced conversion. Means it is a forced conversion of certain preference shares because of certain conditions or certain covenants or whatever which have been breached or for whatever reason get converted. Now preference shares, as we all know, non-cumulative preference shares, the dividend is adjusted when the same is declared, because there is no liability on an ongoing basis. Whereas in respect of cumulative preference shares, dividend is adjusted when it becomes due. Here I am assuming that the preference shares are those which meet the definition of an equity. They are not the redeemable preference shares which are otherwise to be now treated as debt. Now preference dividend, there are certain special issues in calculating or adjusting preference dividend. See, there may be certain increasing rate preference shares, where certain preference shares may be issued at a discount which is compensated by a lower dividend than the benchmark yield, and preference shares which are issued at a premium which is at a higher discount rate, higher dividend rate than the benchmark rate. So whatever is the original issue or discount on such preference shares has to be amortized to the retained earnings using the effective interest rate method and treated as preference dividend. So any premium or discount which is effectively as an adjustment, many companies we see issue 0.001% preference shares. So now that is where you may have to adjust and take it against a normal benchmark yield, against a normal dividend. And like how we would adjust our financial liabilities, on that basis you take it on the basis of the effective interest rate. When you look at the financial statements, instrument standard, you will get an idea. So any of these, so that is where you need any premium or discount, you need to take it using the effective interest rate method, and then that dividend would be treated as preference dividend. Again, I am adding that this is which meets the definition of an equity. That is the basic criteria. Premium or discount on repurchase or buyback of preference shares. So premium is deducted from retained earnings, whereas the discount is added to the retained earnings. But for calculating the EPS, the same has to be adjusted against the profit after tax. So that is one other change. Induced conversion of preference shares. See, you may offer a higher premium to induce the conversion as compared to the original terms. The excess of the fair value of the ordinary shares or other considerations over the value of the ordinary shares under original conversion terms it is like a return, it is like a dividend. So that has to be deducted. So for an induced conversion, the higher amount which you pay, treat it as a dividend and adjust it while deduct it while calculating the earnings attributable to the ordinary shareholders. Okay. Weighted average number of shares, otherwise I think there is okay. So this is simple, I think. Yeah.
In
this number of ordinary shares or weighted average number of ordinary shares.
Yes.
Do you consider the potential equity shares also?
That is for dilution. That is for dilution. We are still on basic.
Okay, where we come to dilution.
Yeah, we are coming to dilution. Yes. Your weighted average number of ordinary shares, how to calculate it in different scenarios, I think that is given. There is nothing great in that. See, retrospective adjustment when there is a bonus issue, split consolidation, all this what we are currently doing. There is nothing same. We need to restate for the earlier period. Diluted EPS. Here also earnings adjustment, any dividends or other items related to diluted potential ordinary shares. Any interest recognized in the period related to diluted potential ordinary shares means essentially any convertible debentures or any such thing which are there, the interest element, any other changes of income or expense that could result from the conversion of diluted potential ordinary shares. See here now, diluted potential ordinary shares shall be deemed to have been converted into ordinary shares at the beginning of the period or on the date of the issue of the potential ordinary shares. When more than one basis of conversion exists, the conversion rate or exercise price which is most advantageous from the holder's standpoint is what should be considered. It should be calculated independently for each interim period. This is relevant when you are doing your quarterly results. Each issue should be considered separately in the sequence from the most dilutive to the least dilutive. I will explain that with the help of an example later on. Options and warrants, again, we all know how we are doing it for ESOP. Based on the assumed proceeds at the average market price, and then the difference is taken as shares issued at no consideration. Similarly for any convertible instruments also, so that is all common, I think nothing much really. Employee stock options also, we all know how we calculate based on the number of shares to be issued into the average market price minus the exercise price upon the average price. Here the only important thing is, especially at the consolidation level, your potential ordinary shares of subsidiaries, joint ventures or associates. Potential ordinary shares to be issued to parties other than the parent or investors exercising joint control or significant influence that are convertible into ordinary shares are also to be just included in the calculation of the diluted EPS if they have a diluted effect. So any such instruments which are issued by the group companies and to the extent it pertains to the minority, not controlling shareholders, has to be also factored into account while calculating your diluted EPS, the potential shares arising out of the conversion. The disclosures are all quite common. See, these are some simple examples which are there. Mandatorily convertible debentures. Mandatorily convertible debentures have to be compulsorily treated as equity from the beginning.
So they will get, yeah, that's
Yes.
the question I was coming to.
Yes.
So mandatorily convertible debentures and mandatorily convertible preference shares.
Yes.
They get factored into your basic as well as diluted
Yes. Yes.
calculation.
Yes. Yes.
Basic as well as diluted.
Yes. Basic as well as diluted.
Okay, then.
Now here there are some constructive obligations to issue shares to KMPs based on satisfaction of certain conditions. So that is where you can just see based on a market price range, you can go through those examples. Now this is another example where there are 2 or 3 different instruments. So how you consider the order of dilution. So that is what is explained. So that is quickly, I think now IND-AS 37 also just very quickly. See, as I said, that is again a standard which has there are 2 or 3 important things which we need to keep in mind as far as IND-AS 37 is concerned. One is the basic measurement principle which has changed, is that discounting has to be done for all provisions where the settlement is expected beyond the period of 1 year. So that is the first basic change which has to be done. The second change is that there is more specific guidance on what constitutes a constructive obligation. Now, what is a constructive obligation? A constructive obligation is basically an obligation which derives from an entity's actions, where because of an established pattern of past practice, published policies or sufficiently specific current written statement, the entity has indicated to other parties that it will fulfill certain responsibilities and a valid expectation has been created. So that is very important. See, take a simple example whereby you go to a retail store and somebody has just put up a board that we will be replacing certain products or damaged products will be replaced if you give it within a period of 15 or 20 days, and you will be probably compensated for the amount. So that means there is no legal obligation on the part of the company to do it, but they have put up a notice. So there is a constructive obligation which is created. There may be certain negotiations also which may be commenced, which may probably give rise to a valid expectation. Mind you, just because the board has taken some decision, that does not give rise to a constructive obligation, because many decisions which the board takes, all of them may not come out within a public domain. But certain board decisions which come out within public domain, maybe if it is a listed company, if it is informed to the stock exchange, some of those may sometimes create a valid constructive obligation, and you may need to factor those in. Suppose the stock exchange informs that we have entered into a wage settlement with the trade union. So that means there is a public announcement which is there. So it could create a constructive obligation. There could be various other examples also. Now, provision should be measured at the best estimate and all that. Probability, rational basis, and all those things are there, nothing much really. The most important thing is this point B, the present value would be the pre-tax rate which is there. Pre-tax rate which reflects the current market assessment of the time value of money and risk specific to the liability without adjusting it for cash flow. So there is a question of whether it is the real rate or whether it is the nominal rate. Real rate is the rate at the current prices excluding the general inflation, whereas future prices including the effect of inflation is the nominal rate. You normally would take the current pre-tax rate. That is what you would normally take.
So can the entity take a borrowing rate applicable to it?
You can take that, yes. That is the current pre-tax rate, yes. No provisions for future operating losses. There is an example which I have kept. Restructuring is something which already is there under guidance under current AS 29. So that is what would continue. You can look at that, what are the components. Only thing is that there may be some constructive obligations. So timing for restructuring, when there is a constructive obligation, only when there is a detailed formal plan, a valid expectation has been raised. The board of directors decision, the impact, I think here there is some guidance which is there. Now here in case of a board decision which is taken before the end of the reporting period, but the implementation starts or a public announcement is made, stock exchange announcement, take as an example, is made after the reporting period but before the financial statements are approved, it would be a non-adjusting event and only a disclosure. So that is only a non-adjusting event, so that is important. Now accounting for levies is okay, nothing much. transition issues and challenges, no retrospective exemptions. So we need to make an assessment of all whatever provisions are there, and if the liabilities are expected to be settled beyond the period of 1 year, then you may need to take the time value measurement. You may have to de-recognize certain reimbursement assets which are not virtually certain. I'll just spend a couple of minutes here. See, we have this concept of reimbursement assets and claims which are receivable. Currently, I think we have been recognizing those on the basis of reasonable certainty under IND-AS 29. Now these have to be recognized on the basis of virtual certainty. So any of your insurance claims or any receivables from the government or whichever you may have, only if it is virtually certain, only then you will have to recognize them. So at the transition end, you may have to make an assessment. This is something which I don't know how vigorously companies implementing it in the first phase have really done it, but this is one potential area which is there. So that is what will have to be kept in mind. Settlement of legal cases after reporting period may trigger a present obligation. See here again, IND-AS 10, events occurring after the balance sheet date state, that when there is a legal case which has happened and it has been settled after the reporting period, and if the matter, if it pertains to a contingent liability and it has gone against us, we may need to take cognizance of that and then change a contingent liability to an actual liability. Now here again we have practical challenges which are there. We all know that ours is a very litigious society, and especially on tax matters there are litigations which happen at various levels, in various forums. So here now, suppose after a balance sheet date that there is an income tax matter which has gone against you at the lower level, but you have an offshore of an entity. So in such cases, in my view, we may not necessarily have to adjust. Only matters at the High Court or the Supreme Court level which have gone against us, and where there is now no scope or very limited scope for further appeal, or we have also accepted the stand of the authorities. So then those would have to be now then moved from a contingent liability to an actual liability depending upon the actual outcome of the judgment. So that is any post-balance sheet, it becomes an adjusting event in terms of in terms of IND-AS events after the balance sheet date. So that is what also you may need to take an assessment on the date of transition. The disclosures are same. See, this is an interesting case study on CSR, which you all can just read. Whether it creates a constructive obligation. The answer is not in black and white, again it is something which is in gray. I think it is there in Mr. Dolphy D'Souza's book, I'll just confess. I picked it up from there because I like this example. See, you are formulating and recommending which would indicate activities, monitoring disclosures in the board report and on the website, I mean they could trigger. So you need to factor those in. Otherwise, some of the other case studies, I think on restructuring and all that, you can look at it. Here also enactment of a legislation which is virtually certain or which is substantively enacted, that concept is brought out in probability assessment. You're discounting how to apply.
Can the discount based on the change in the discounting, based on the change in the discounting rate?
Yes.
And the provision be revised in the next year?
Yes, it has to be, and you need to make an assessment.
So it
yes.
needs to be reassessed at each reporting period?
Yes, yes, absolutely. Yes, that needs to be reassessed. So anyway, I've tried to do as much justice as I can. I wish more time would have been given. I think we have tried to cramp up too many important standards together. I think we need to be a little cognizant of such things in the future. I think an income tax standard and the other things have been clubbed together. We need to probably be careful because otherwise it's not fair to the participants also. Anyway, thank you very much.
I have some questions for you after the session.
I think we can take probably one or two.
In fact,
Yeah, we can take one or two questions. I think now 5 minutes more will not make much of a difference.